ISAs are the most boring, ridiculous, and non-essential investment strategy you should ever be looking at. Is what I would have said 5 years ago, but things have dramatically changed since then, and you need to listen to this video if you're interested in financial freedom and becoming a millionaire in the next 30 to 40 years. Hi everyone, my name is Jamie York and welcome to my YouTube channel where I talk about everything finance, mindset, business, and of course property investing. And if that's what you're looking for, make sure to hit the subscribe button and do me a favor, smash the notification bell as well so you're prompted in the next video. And hey, if you've got 5 seconds whilst you're watching this, just hover over and lightly touch the like button, and it really does help me out with the YouTube algorithm. So let's jump in. What the hell is an ISA? So an ISA is essentially a tax efficient protection of your money. And up until recently, and when I say recently, I mean the last couple of years, I thought they were the most ridiculous concepts ever because I didn't understand the different types of ISAs. So here's what I thought before. An ISA, you have a yearly limit. When I was looking at them a while back, they had a yearly limit of 15,000. They currently have a yearly limit of £20,000. And the whole idea of it is you don't pay tax on anything you make within that ISA. That is right, 0% tax for everything you make within that ISA unless you take it out and start earning money on it separately. The reason that didn't really excite me is I've got the ability with what I do in property investment to make double-digit returns on a yearly basis. So why would I be interested in saving tax on the 0 point fuck all interest rate that you get by putting it in the bank or holding it in cash, right? All good paying no tax, but if you don't make any money, then you're not going to get taxed anyway. That was until I completely realigned my expectations of what ISAs are, and the only thing I'm gutted about with ISAs is that I didn't start earlier. So there's different types of ISAs, and before I get started, it's really important to say I am not a financial advisor. I am not qualified to give financial advice. What I'm sharing with you is my opinion on what you should be doing to have financial freedom in your life. So, type of ISA number 1, which my opinion is absolutely worthless, no point having at all unless you have got a ridiculous amount of money sat there, is the cash ISA. Just why? Like, you're not making anything. If we were back 25 years ago where interest rates were absolutely stupid high in the bank, then yes, I'd maybe want to protect that capital as much as possible, but they're not right now. As I said, there's talks over this year about negative interest rates, let alone paying us a decent sum for having it. So what you have is something called stocks and shares ISAs. And what I'm going to be doing in here is showing you what I do, where I put my ISAs, how long ago I started and where we've got from then, and how you can do the same too. So, pretty self-explanatory. In a stocks and shares ISA, what happens is you put your money in and you have the ability to either put it into an ETF, which I'm not going to go through in this video, but I will do later because it's a very safe way, index funds, which is very similar, or investing in stocks yourself, and then you leave it in there and you benefit from the long-term growth of those things. What's important to say at the moment is I do not technical trade. When I'm buying stocks, there's 2 ways of trading. Number 1 is technical analysis, and one of them is fundamental analysis. So whilst I do look at technical, which is the charts going up and down and the candlesticks and Fibonacci, all of that sort of thing, I'm looking at the fundamentals of the business. Let me give you a quick example, and one I always like to use is Coca-Cola. Okay, now I'm not going to go through the story of it, but Warren Buffett, possibly one of the best investors that's ever lived. He's a fundamentals trader. He will buy into the fundamentals. So whenever you see him in a commercial or a video or a film or a documentary, he always has a can with him, okay, because he's promoting it knowing that millions of people will buy into that just from seeing that can. Okay, very clever guy. And what he will wait for is these brilliant companies with great management, and he's waiting for negative publicity or a negative point in the market where the stock drops because he believes the business isn't worth any less. He thinks it's worth the same amount of money, if not more, hence the chance of investing, but he is getting a discount on buying into that business at that point, so getting it pennies on the pound or cents on the dollar, depending on where you are. Something you need to understand with stocks and shares ISA is they are described as volatile, okay? So this is really important, and I'll give a great example. I've only had a stocks and shares ISA for 2 years now, so I'm capped out at the 20,000. I'm going to tell you how I break that down. So I've got 40,000 in there, and I'm currently at about 54,000. So it's only been actually a year, because what I did is I only started it in April 2020, but your tax year is April the 5th. So I put 20,000 in on April the 2nd, something like that, and I put 20,000 in on April the 7th. But there's a very specific way that I did it, which I'll share with you in a moment, with something called a LISA, or a lifetime ISA, which you want to maximize as well if you're investing for the long term. But the reason I'm mentioning volatility is it can go like this, especially at the moment with everything that's happening. In general, you want that upward trend, okay? But stocks will go up and down. Just as an example, Games Workshop, who I invest relatively heavily in, I would say, as a portfolio. I love them. I think they're a great company. I think they're going to be really well. I'm up 50%. Or I was up until last week, and now it's dropped by 10%. Okay, so technically I've lost 10% of the value of that stock in just 1 week. But I don't care. I really don't. It doesn't affect me at all, because I'm looking to exit that in probably 3 to 5 years. And might not even then. I'll reevaluate the stock, and would I buy in at that point as well. Okay, so there is volatility, so you need to look into the medium to long term. So how do you do it, and where should you place your money? Okay, so first of all, where should you place it? What platform? There's a lot out there. Nutmeg, Hargreaves Lansdown. There's so many to list out. I'm not going to. For stocks and shares, do your research. Okay, there's a hell of a lot out there that are really good, especially with ETFs and index funds, which I'm not going to touch on in this video. But for ISAs, I personally think Hargreaves Lansdown, I'll put a link below so you can go straight to their website and see what I mean. What you need to be careful of is fees, okay? So for Hargreaves, or HL, Hargreaves Lansdown, they have a 0.5% yearly or annual fee if you're holding long-term stocks like I am, and that's capped at £45. But you also need to be aware of when you trade, you get a charge on that. So if you're about to buy £1,000 of one particular share, bear in mind you're probably actually only buying £960 or something like that. So as soon as you buy a stock, it will show as minus 8% or something like that. So you really need to believe in the long term of this. But do your research. Again, this is not financial advice. It's just for ISAs and only ISAs. Outside of that, I'll use different trading floors and stuff like that. But within ISAs, Hargreaves Lansdown, I find to be the best quality, customer service and range of stocks that you can invest in right now. So as I said, there are 2 types of ISAs within this that I invest in. One of them is your standard Hargreaves Lansdown stocks and shares. So we're S&S with Hargreaves Lansdown, and I will put £16,000 in that one. Now bear with me, because I know I said £20,000, so I put £16,000 in that, and the reason I only put 16,000 is because I'm currently 29 years old, and if you're watching and you are between the ages of 18 and 39, you can set up what is known as a LISA, or a lifetime ISA. Now this only makes sense for 2 types of people. Either you are looking to buy your first property, or you are not looking to take any money out of this lifetime ISA until you are at least 60. So in my situation, I've got excess cash that I'm not able to spend or utilize in the areas that I do because of the businesses that I've got. So I'm able to plant money, and I don't intend to ever take money out of this. I'm going to hand it to my kids and stuff like that in the future, or maybe my grandkids. So every single year, you can put in £4,000 into the lifetime ISA, but it counts towards your overall £20,000 budget or allowance that you can put into an ISA every year. Still with me? Okay, so we've got £20,000. Now here's why it's amazing. 12 months later, you can use this money as towards a deposit for buying a house. You can't do it less than 12 months. So if you're buying your first property within 12 months, this isn't going to help for that. But here's where it's magical. What the lifetime ISA will do, the government will give you £1,000 on top for free. Every year. Every year. Right? So you're no longer investing with £4,000, you're investing with £5,000. So every single year you put in 4,000, even if you can only put 4,000 in, which is 366 a month. I know that's a lot of money, okay? But 366 a month, if you could put that in a stocks and shares, ISA, £5,000 at an average growth rate of 5% over 25 years, you're going to be close to about £1 million. What? Okay, and I'll show you the math on that in a moment, just so you can understand when you become that millionaire. We'll see how close we are actually on that. But you are starting 25% up. Now again, you shouldn't be taking this out before you're 60. If you do, they will take the money back. Which, by the way, still isn't the worst case scenario, because you basically had £1,000 every year that you're investing upon getting that return on. But how crazy is that? You can put £4,000 away, 366 a month. It's actually less than that, 333. Sorry, my math not so good today. And they're going to give you an additional £1,000 every single year. So what are the benefits of this ISA and the downfall? So the benefit, obviously, is no tax. Now, I get it. If you're starting out, when you're not earning that much money and not investing that much money, the tax isn't really going to make a difference. But you want to get into the mindset of protecting and preserving the capital that you're earning from an early age and from when you're starting out. Because if you learn how to save 20 pence on your pound, you're going to be great at saving £45,000 on 100,000. And by the way, when you get to 100,000, which you will if you're watching stuff like this and implementing it, 45,000 is what you're going to get taxed or close to that moving on. So number one is zero tax from within that, okay? That's a big one. Number two is potential growth, okay? And I'm going to underline potential there because it's not guaranteed. Remember, this is an investment. It's potential. There's risk applied to it, and I'm not a financial advisor. So potential growth. This is not cash. This is not holding it in your bank account where you're getting 0 point nothing in the bank account right now. You have the potential of growth over the long term. But that brings me on to a negative. Let's go and see if we can get a nice red. Brings me on to the negative. This is classed as a volatile investment. Okay, so again, just so people understand what volatile means, it means movement of prices. Okay, so volatile is, what we would love is predictability. Okay, but the world isn't predictable. You don't know what the manager's going to do. You don't know if somebody's going to steal money from the company. You don't know what's going to happen in the macro and micro business environment. But we'd love it to go like that, right? Wouldn't that be nice? Predictability. No, actually what happens is this. So it might have that curve, and in general, it will follow that curve up. And that's the important thing to remember, okay? Now, how do you overcome that? Very simply, grab your pens and paper, write this down, okay? In green, we're going to go with time in the market will always is going to beat timing the market. It's a really simple concept, okay? Unless you are one of the pros working with the best software, usually in London or New York, where they've got these incredible computers where they're sensing these tiny movements, and they're technical traders, which, by the way, most people, and this isn't an opinion, there are more people losing money technical trading than making money. It's just the people that consistently make big money, so it outweighs the losses sometimes. But in general, you cannot time the market. Do not try to time the market. This is like Bitcoin. Recently, it's gone to 28,000 and people are like, oh, it's going to go to 50K. And then it dropped to 24 the next day. Okay, does that mean Bitcoin's a bad investment? No, it's a risky investment for sure, but you don't understand that, okay? So it's about getting into something and watching it go from A to B over a decent duration. Look at Tesla is a great example. If you look at that, Elon Musk at the time of this has just become the richest person in the world. You could make $250,000 every single day since the birth of Christ, and you still would have less money than him right now. What? Right. But did that happen overnight? No. If you look at the stock price of Tesla, it was nothing for years and years and years. And even in the last year, from when he was smoking weed online and it dropped like 30% overnight, when he said Tesla stock is overpriced, it dropped 20% overnight. You cannot time the market. It's all about being in the market, and time in the market will always beat your timing. So I've got 2 more points to cover on this that really will help with time in the market, okay? Now, let's go back to that 4,000 pounds example on a lifetime ISA. So let's work out the math on that. Let me grab my phone. So if I say 4,000 pounds, that's actually quite a lot of money, right? So a ridiculous amount of money, but you can do £333 a month if you can't work on making, managing and multiplying your money more effectively, okay? But what we're gonna do is that's gonna be £4,000 plus £1,000 from the lifetime ISA, okay? Now this is called, and this is from originally multiple streams of income. Can't remember the guy's name, I'm really sorry, it's like a 40-year-old book, but something called dollar cost averaging. Now, if you're watching in the UK, which most of you are, pound cost averaging, but the guy that came up with it was an American, so dollar cost averaging. And this is about the timing of the market. So we're going to assume a 7% growth, which is very standard in the market. It's actually a bit higher overall. But what it means is, overall, if you go from here to here, that will be a 7% increase from there to there. But what actually happens is something like this. It won't be as dramatic as that, it will be smaller, but in general, it's going from there to there consistently on a yearly basis. So what we're looking at is the compound effect of this over the long term. So this is the 8th wonder of the world, as Einstein said, and people don't really understand that, again, I've drawn this so many times on my videos, but growth is not like that, it's kind of more like this. And people get shocked just how vertical the end is. So a really good example is, you know, would you like £100,000 today, or would you like a £1 coin that can double in value consistently over a 35-day period? And if you understood that in 35 days you would have well over £1 million, you'd kick yourself, right? But that is the power of it. I'm not going to go through the math on that. It's just the power of compounding, and look up that example. Actually, it's not even a pound, it's a penny that doubles in every day, and day 33 you've got £1 million. So I've done the math on an Excel spreadsheet, and guys, if you want a copy of this spreadsheet so you can actually put in your own numbers, comment spreadsheet below and I'll give you a way that you can get hold of this as well. But trust me on my numbers for now. Alex is looking at me like, oh God, now I need to make sure we've got that spreadsheet available. It's all good, but it's showing this compound, okay? And I'm going to show you how, by implementing this just over a 40-year period. Okay, so if you are taking it out at 60 and you are 20 years old, starting just this ISA, and all you add is this equivalent of 5,000 a year, or it's 4,000 a year, this is the power of compounding. Now remember, at 7%, if you've got £5,000, what you're going to have at the end of that year is £5,350. How did I screw that up? £5,350. But what you're also going to do there, if you time this right, is you're going to have another £5,000. And hopefully you're going to be able to add this up over and over and over and over again. So I've put this on the spreadsheet. I need to test it and tweak it to make sure I've got the formula exact. But give or take, I really want to show you this so you understand the power of compound interest. And I've asked Alex to blur out part of the screen as I'm going along, and showing this bit by bit. So let's start with this side of things, year 1 to 10, and then I've broken this down as we're moving forward. So if we look at the first 10 years down here and we'll blank out all of the rest, year 1 we've got 5,000 and something. I've just put the first figure, but year 2 you've got your interest plus your 5,000, so we're at 11,000, 17, 23. Look how this is building up, and bear in mind this is adding £5,000 a year on top of your interest. Look at how the gap gets bigger every single time. So we're at 6,000 gap, 7,000 gap, 8,000 gap, around 8,000 gap again, and again it will sort of push in. Then we're suddenly going to £54,000, again 8,000, 64, 10,000, 73. We're getting bigger now, £9,000 gap. And this is just the exact same percentage increase and adding that £5,000. Remember, all you're adding is £4,000 a year, and the lifetime ISA is giving you that extra £1,000. Now let's start jumping in 5-year periods. And Alex, if we can release this one by one. So 15 years, £134,000. You're still only adding 4K a year of your money, 1K a year of the government's money and the interest. 20, we're at 219, 25, 333, 338,000, 30 years, £500,000. Just by putting 4K away at 7% every single year, tax-free, every single year, and getting the government to give you an extra £1,000. Okay, you are at £500,000 within 30 years. 35 years, we're at 739 years. And then we get to the coveted magic 40-year period. You are hitting £1,068,000. Net worth millionaire status by putting £4,000 away. You can make that work, okay? Now, what's crazy at that point, and hopefully you're able to, as you get older and as you're making more money, hopefully you can add more than that. Imagine if you're adding the £20,000, and actually, I'll put that in the spreadsheet. Alex, can you make a note of that? Because let's face it, I'll forget about it. I'll add that into the spreadsheet to show the compound effect of 20,000. You're going to be shocked at that, by the way, because that would be multi-millionaire status at that point in time, okay? Now, what's interesting is, let's just say you put £4,000 away. Now, I know there's going to be inflation, and if you're earning 20K a year or something like that now, that's not the same as down the line because you've got your 3% or whatever it is every year. But if you're still getting 7% on that, let's just take out that 68,000. Let's just call it a flat £1,000,000. From your £1,000,000 stocks and shares ISA, on average, you are going to be earning £70,000 every single year from that. You can retire just on your ISA. How incredible is that? The final step of this is that's great for you, but let's start thinking about generational wealth. Let's start thinking about legacy. Okay, if you're around my age, that's going to be your kids, and thinking about your kids, which, by the way, you have a child or junior ISA, which has a limit of £9,000 per year. So again, if you're starting, imagine this, making your kid a millionaire by the time they're 40. Okay, now make them work for it and stuff like that. I'm not saying give it to them, right? But that's only if you do your 4,000 or 5,000. You can put up to £9,000. If you're a bit older and you're watching this and you're sort of, let's say you're 50 to 60, maybe you've got grandkids starting to come through, I was going to say, come through the pipeline of that. But once you've sorted yourself out, the real amazing financial opulent feeling that you've got is this generational wealth, okay? Imagine starting your kids off, imagine starting your grandkids off in the right way. So that is my journey of how I went from thinking ISAs were the most ridiculous thing going, don't understand why people were getting obsessed with them, to obsessing about it myself, to thinking about it as the key component of creating financial opulence in my life, my kids' life, and eventually my grandkids' lives, and how you should be implementing this too. Now, I know this isn't my typical video, but again, if you're interested in this sort of thing, finance, personal finance, wealth, property investment, and of course mindset, then make sure you're subscribing to the channel, hitting the notification bell, and it would massively help me out with the YouTube algorithm if before you go and click onto the next video is hitting that like button and leaving me a comment below, and I'll make sure to respond to every single one. Hope you've enjoyed yourself, hope you've learned a lot more. Remember to comment spreadsheet below if you want to get access to that, and of course I'll see you in the next video.